Good morning. It's a great pleasure for us to meet you again for this third webinar. After the first one, we dedicated to the precious metal markets and the second one to our fund Eurocredit short term. We want to provide you with our economic and financial market views. This is why this webinar will be animated by Jean-Marie Mercadal, CIO at INT Asset Management, who will present his recommendations. Good morning, Jean-Marie.
Thank you, Christophe. Hello, everybody. Thank you for attending our webinar during this very tough time. I hope you are all in good health. Well, we are in a situation that is quite complex at the moment because we are facing one of the worst recessions in history. But thanks to central banks and thanks to government actions, the worst has been avoided on the market. So we are navigating today between these two logics, abundant liquidity and of course very appealing fundamentals. So if we go to next slide, you can see how huge has been the recession. The world global economy has switched to off mode during a very short time. And this sudden shock was caused by the globalization of the coronavirus. This epidemic, we think at the beginning, could stay in Asia, but of course it has spread all around the world. So today we are facing a very tough recession. And let's hope that after that, the world will be a little bit different, because now we know that health is an asset that we have to take care of. And we understand that after that, what we have done for health, we can do it for ecology transition and carbon consumption. So let's hope we will have after that a greener economy. And of course, the online economy is a big winner of that. And probably it will go on and accelerate again. So if we go to next slide, we can have some figures that are very, very impressive. At the beginning of this year, IMF had expectations about 3 to 3.5 growth for 2020. And this growth was recovering at a steady stance, and we were confident about that. So the shock is huge, is massive. And today you can see the expectations. Now the forecasts are for -3 for the world economy for this year. And if you look at developed economies, the figures are very impressive, because on average it is close to -6%, with more than that on Eurozone, -7.5%. Very huge revisions. On emerging economies so far, well, we can expect a kind of stabilization, because thanks to China, but at the beginning of this year, expectations about China were close to 6%. So this is also a huge down revision. And we can, expect more revisions coming, and probably we will have a recession worse than that, close to maybe 4%, with a lot of forecasts now published close to these figures, and something between around 9% for Eurozone. So this is a very, very huge recession. After that, for 2021, of course, we will have a kind of recovery. But the question is about the shape of this recovery. We think we will experience a U-shaped recovery, and it will take time to go to the levels of 2019, because the lockdown will be lifted only slowly. And of course, unemployment has risen everywhere very sharply, and people are a little bit afraid of that. This is the reason why we see more savings among the populations. And of course, there is a risk that a lot of small corporations, small industries go to bankruptcy because of this sharp recession. So a very hard shock. And if we go to next slide, of course, this is quite logic that the shock has been very important on equity markets. So we can see after a long bull market on the US, especially US equities, the shock has been very sharp. And we had during this, we can call it phase one, a sharp decline of close to 35% on equity markets in less than 1 month. So much more faster than all the crash before in history. Then we had a phase two, a sharp rebound, close to 30% on US equities and around 25% on the Euro equities. This rebound is due to the actions taken by governments and central banks, of course. This is the reason why. But we think right now we are entering another phase. We call it phase three. And this phase will be probably less linear right now. And we are going to have some trading range, a lot of hesitations about the outcomes of this sharp decline. If we go to next pages, well, the same shape on bond yields, especially on US ones, because in US it was the last government market among big countries where you could find some positive yields. At the beginning of this year, 10 years government bonds on the US was close to 2%. Right now is 0.65%. This is due to the US Reserve Federal rates that reacted very rapidly during this crisis. So right now, what we have at our choice, what kind of choice we can make on government markets? Well, in fact, no choice, because every yield has converged to 0%. In Germany, we are close to minus 0.5. Even in France, we are on negative yields, 0 on Japan, and 0.6 on US. So a huge convergence on long-term interest rates on govies. And we think we will stay for a long period of time close to this zero level, and we don't expect any move around starting from now. And for the coming months, probably stabilization around these levels, unless we have a euro crisis. But so far, for the big countries, close to zero will be the new norm, new normal, we could say. So if we go to next slide. So concerning short-term interest rates, so yields are also close to zero and will stay at these levels for the coming months, probably. The Federal Reserve, Jerome Powell, explained markets that he is not ready yet to go in negative territory. So probably a stabilization at this level. And concerning ECB, ECB also is a little bit reluctant right now to go further because interest rates are already in negative territory, and money markets performance in Eurozone will be this year probably something between 0.3 or 0.4, and it will last for a long time because now central banks have other tools at their disposal, and we have listed some of them on the next slide. So the Fed decided to increase very sharply its balance sheet. QE measures were announced very rapidly and on a much larger scale than during the last crisis. We can see on the chart low left. Well, now the Fed has decided interventions concerning the high yield market. That is quite new, either in the specific names or through ETFs. And ECB, they accept also high yield bonds that used to be investment grade as collateral for banks to find money. So this is a very important step in the utilization of money central bank policies, and they are maybe they can use other tools because there are potential tools available. We can go to buy equities. They can buy equity. Why not? Bank of Japan did that, and a lot of the assets belonging to BOJ are composed with ETFs on Nikkei. So they can also control the yield curve and so on. So their power is unlimited. So this is the reason why markets have rebounded so sharply. So we can say to some extent that there is today some kind of central bank puts on the market. So if we go to next page, the problem, we will see after that, the problem is about corporate earnings. But what to do right now? So as I explained, you can imagine investing in government bonds today, well, not very interesting, no potential, no yield. But you can invest in investment grade bonds because we think they are attractive again. Of course, since the last peak in March, well, spreads have reduced a little bit. But right now, you can invest at something close to 1.4% yield on a lot of good names among the investment grade bonds. So we think today it's very interesting, and especially on the short end of the curve, because this curve is quite flat. So you can have close to the same yield, around 1.3, 1.4 yield on a 1 to 3 year portfolio. So probably something, if you don't know what to do and where to invest, if you invest in money market, you are sure to get a negative performance. So it's a good alternative to invest in short-term investment grade bonds. This is the same concerning high yield. On next slide, concerning high yields. So also there has been a sharp rebound in April since the lows during March. But this is still interesting. Yields are close to 6% at the moment for a horizon of 4 to 5 years maturity. And implied default rate at the moment is close to 40%. So we never experienced such a level historically since this asset class exists. So some kind of exaggeration in that market. So it's a good timing to invest, we think, in this asset class. But of course, you have to pay attention on the liquidity. So we advise our clients to invest in high yield bonds with a buy and hold approach. And this is the reason why we are proposing at the moment some kind of program funds with dated funds, so that our client can invest in a diversified portfolio and just wait for the yields. And of course, be careful of liquidity, as I said. So next slide, we will come to equities. So as I explained, markets today, we think they are not reflecting all the downward revisions in corporate earnings that we are going to have. Of course, analysts are a little bit late behind the curve because the recession was so sudden that they have to adjust, and they didn't adjust so far, we think. Even if we can see the chart, revisions are now pointing right to the south, but it's not over to our minds. We prefer to trust top-down analysis at the moment, and top-down analysis that use metrics using recessions and the impact of recessions on earnings. Probably it will be close to minus 35% on corporate earnings downgrade this year, minus 35%. That means if you look at this example about S&P 500 unit, so that means that we started last year, we had 1,6,200 US dollar per unit of index of profit. So that means this year minus 40%. So that means the price earning ratio of 2020 is around 27 at the moment. And let's assume we go back to the 2019 results. So the PE ratio would be around 17. So according to us, it's a little bit too expensive, and especially if you consider that visibility is very low. So we would prefer to invest again in equities during further consolidations. And we think equity markets can go down between 10 to 20%. And if we have that, we will invest again in equities, because valuations, it means that valuations on the normalized year would be around 15 for US equities. And if you compare these equities with a zero yield on government bonds, it would be okay. So at the moment, a little bit too expensive, a little bit too pricey. If we have a consolidation between 10 to 20%, we could buy again. On the next slide, you see exactly the same concerning euro equities, exactly the same, and probably a sharp decline of also 35% in corporate earnings. So the same conclusion also. It's better to wait a little bit before investing frankly again in equities. And if we go to next slide, you have a snapshot of our core scenario. So at the moment, we think that markets are pricing rather rapid exit of this crisis. Of course, the confidence has been accelerated by the support from central banks and governments. But on the other hand, the rebound has been too sharp, and things will be more complicated. So we think we today not so much potential for equities, and we can expect a wave market in the coming months. So on fixed income, a stabilization on govies around zeros, and a good timing to invest again in investment grade and high yield bonds. Emerging market bonds also could be an option, because yields are close to 5 to 6% on local debt. And of course, they have been also affected by all this crisis, economic crisis. So a lot of currencies seem undervalued at the moment, but this asset class could be more volatile. But it's also an option. On equities, I explained that on the short term, well, we don't see much potential. Concerning Forex, we think that gold, US dollar could stabilize, and gold is also a good option in that environment with real rate negative. And also after that, you can have a kind of lack of confidence about what is the real value of currency in a world with so much debt. So this is our core scenario. What are the main alternative scenarios? The first one is a V-shaped recovery. Why not? If you can imagine that around September, everything will go back to normality. Of course, after that, we didn't have damages on industrial production and so on. So you have just to put the on button, and you just had created some debt, but all these debts has been bought by central banks. So where is the problem? So you can start again with interest rates very low and oil at $25 US per barrel. So you can have a V-shaped recovery in that situation. This is an option. We don't believe on that, but it could happen. And the other main alternative scenario is a long time, a L-shaped recovery. So that means the economy never start again only after a long period of time due to all the problems we could expect from that kind of virus that nobody knows really how it can spread again or whether or not it can spread again. So these are our main conclusions, and now I could answer some questions, and especially because I forgot to add something about ESG that has been very consistent during that period of time.
Thank you very much, Jean-Marie. So yes, we have received some questions, and in fact, as you mentioned previously, there is one concerning the SRI funds and the ESG in general. So could you please tell us what was the behavior of these ESG funds globally during the last month?
So, during this period, we have made some calculations and some observations, and we noticed that ESG funds had overperformed their peers, and especially during the stress markets, as I explained, the phase one. We had some calculations about that, more accurate figures, and we noticed that ESG equity funds overperformed by 4%. So this is quite significant. And it confirms that on a longer term, ESG performance is higher than average performance. So this is very encouraging for all this way of managing money. Now, I just wanted to add that we are going to make further studies about that, and we will publish some information about all the ESG performance during this financial crisis.
Thank you very much. On this slide, you will find the next webinars that we have organized until the end of June. So thank you very much for your attention, and goodbye.